Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Talking about another stock that we used to own in the Crassus portfolio, Freeport McMoran. We made a great profit on this, so I'm going to break it down for you today and tell you what I think of the business and its prospects looking forward. For me, it's one of the better plays in the copper sector, and we'll briefly touch on why that's important, but I might do another sector review later down the line, purely on the copper space. Okay, thank you to those who have subscribed already on YouTube and are leaving me comments and questions. I really enjoy the questions and the conversation, so by all means keep that up. And if you haven't liked and subscribed, I would appreciate you doing that. Helps the YouTube algorithms get the videos out there. I'll always be managing the fund, but it just depends on the engagement as to how much effort or to whether or not I keep doing the YouTube content moving forwards. So the Crassus investment formula, quick recap. We're looking for companies for low debt, margin of safety, sales growth, strong margins, free cash flow growth, and our share buybacks. If we can get those, we will be really happy to purchase at a good price, of course. Okay, quick facts about Freeport. The revenue is tipped to come in about 23 billion this year, 9% compounded annual growth rate, which is really good for a capital-intensive business. EBITDA at 10.6 billion. 17% CAGR over the same period, so they've been able to grow their margins. If you see EBITDA growing at a faster pace than top line sales, that means their margins are increasing, which is obviously what you want in a business that you own as a shareholder. Market cap 57 billion, enterprise value 69 billion, price at the time of recording $38.85 US. 1.5 billion shares on issue. A little bit of dilution last year, but if you look over the 5-year period, they've basically been flat. So no issuances, no repurchases. Dividend yield, not much there, but a little bit. Return on capital, about 8% over the last 5 years. Net debt is 12 billion. Okay, so 12 billion in debt on the balance sheet. And depending on the analyst that you use, this is a bit confusing. So if you look at the market cap to enterprise value, difference between the two, that would obviously suggest 12 billion in net debt, but some analysts have 6 billion net debt on the balance sheet for the company. So a little bit confusing. I've gone with the enterprise value simply because I think it just is better to err on the side of caution. Net debt to EBITDA is 0.4. We're looking for 3 or less generally for a long-term investment. But the reason I've added in the actual number from the balance sheet, the total of net debt in its aggregate, is because if you see the EBITDA start to fluctuate, and it will with the underlying commodity price, mainly copper in this case, then let's say copper falls off a cliff tomorrow, then you'll see the EBITDA drop and that ratio will spike upwards. So you can get caught with that. So just be careful. Okay, some key points. It is a commodities producer, as we know, mainly copper. They do gold and some other metals and rare elements, but basically copper is their game. They're the number one producer that people look for in the publicly listed copper space. The electric vehicle boom is the thing everyone's talking about. So where you look at the amount of copper in a standard automobile today, if you take a battery electric vehicle, they want 5 to 6 times more copper, okay, for all the extra wiring that goes into the electrically powered vehicle. They're a global producer. They've got mines all around the world. There's a good one in Indonesia, which we'll be touching on in a moment. The Freeport have exceeded the analysts' earnings predictions 3 out of the past 4 quarters, which means that analysts aren't really up to date with the inflationary narrative when it comes to commodities, okay? Here's an interesting stat. So Citibank have got a price target for copper, $10,000 a ton to $12,500 is what they said. That works out to be about $5 a pound. I am kicking myself because I bought a lot of swaps and natural gas derivatives, same with oil early on last year, and made really great returns out of them. And for whatever reason, I didn't buy any copper futures, so I'm a little bit annoyed with that. In any case, with the price of copper hovering around $4.20, we're in an interesting position. It's not a low price for copper, but if you look into the future and discount it, maybe it is a low price because prices are going to exceed our expectations historically. So it's an interesting one, not easy to pick in my opinion. I think, yes, I agree with most analysts that copper is going to be a hell of a lot more important, and we do have a dearth in supply and increasing demand. We'll see. I think it's just run a little bit too far too soon, but who knows? Crazy things can happen in the current world, especially with supply chain shortages and ample excess liquidity. Okay, so here we're looking at the rising demand. We know what that is all about. It's this green energy narrative, and that's going to rely on a lot of green electrical producers. That's going to need copper. So your solar panels, your wind farms, electric automobiles, as we mentioned, copper is going to be in huge demand moving forwards. Supply scarcity, we know that a lot of the copper mines are old. Okay, they're very, very old. The pipeline is thin, and your lead times for greenfields or even brownfield exploration or development is, not less than 2 years in most cases. Okay, so it's going to be interesting. You can't just flick a switch and the copper mine starts producing more copper. A lot of people don't understand that. Okay, this is a great chart. Got it from an article which I've left down below here, so you can check that out. Here we're looking at something very interesting. So we've got this highlighted. This is the Indonesian component of Freeport's business. You've got the equity component held by shareholders, okay, and the rest of it is held by the Indonesian government. So interestingly enough, before the end of 2023, you'll have as a shareholder 81% equity in the mine, and then you're going to have a very steep haircut there. The government is one hell of a racket, what can I say? But you're going to need to factor that into your projections into the future, because you don't own as much of that particular productive mine as you thought you did past the 1st of January 2023, because the government's going to be taking more of an ownership there. So if we look at, this is a sensitivity table, okay, sorry about that, but I had to really blow it up so you could see. Copper price over the top here gives us an indication as to the EBITDA in billions that the company will expect when you're taking into account a sliding scale here of shareholder interests, okay, so percentage interest. So as you come up the dependent variable here, you'll see more of a dilution. So if you have the government taking more of the equity, this is what you can expect at the various different copper prices if you follow the cursor there. And then likewise, if you were to revert back to a higher percent stake for the equity holders, and by that I mean the private equity holders, the shareholders, you and I, then you'll be looking at these rows down here according to the percentages, okay? So if we were to take a base case for $4 copper, we would expect, without any further dilution, around about 3.9 billion in EBITDA, okay, coming into 2023. And if you look down here, this is the free cash flow yield when contrasted or compiled against those two variables, okay? So about 8.1% yield at $4 copper price. If Citi and JP Morgan and Goldman Sachs also have got a high target price of copper around about the $5, you would just simply take the percentage ownership in which you're happy to project, let's say 40%, and you'd slide that along to the appropriate cell in the matrix. So you'd then be looking at, if you follow the cursor there, at 5.8 billion in EBITDA, and you'd be looking at around about a 12.2% free cash flow yield. Here's a quick look at the price action over the last year. It's a leverage bet on the copper price, as you can see. Not surprising at all there when we understand the business and what they do. Over the long term, this gives you a really good look at this, the cyclicals, okay? The cyclical nature of commodity producers. When you look at some of the dips here, we've got to make a decision to say, look, what was causing that? So we look 2008, there's a GFC, so you're not going to be pumping out a whole lot of extra infrastructure after you just had a liquidity crisis. Then you've got energy bull market fall off a cliff, China fall off a cliff at 2016. Then obviously you have COVID, and so it just looks like copper is on an absolute mission. The question is, will it revert to mean where I would estimate very roughly that a Freeport, I should say, will it revert to mean with the copper prices reverting to mean around the $20 mark, or will we actually see those sustained higher prices into the future? That's the question that you need to ask yourself as a potential investor in Freeport, because you're a potential investor in the copper theme itself. If we compare to peers over the last 5 years, Freeport has outperformed. Here we've got Rio, Vale, Southern Copper, and BHP. So Rio's slightly less interested in copper. They're a big commodity producer. Vale, mainly iron ore, but they do have a copper component to their business as well. Southern Copper there is the big one, and obviously BHP are basically in everything. So that's just an interesting contrast, comparing each company. That would be your relative valuation. Okay. Quick projections out into the next year. I'm going to talk about why this is important. So for me as a portfolio manager, I'm looking obviously for the IRR. It's not just aggregate return. I'm looking for that on an annualized basis to be able to give you, if you're invested in my fund, I need to protect your capital, number one, and to be able to grow that, number two. And in doing that, the reason we have discounted cash flows analysis is because we're discounting the time value of money. And that's why annualized returns such as IRR is such an important metric, rather than just using total returns in the aggregate. So let's have a look. I'll come back to that. Free cash flow per share, EBITDA on a per share basis, and earnings per share for the end of are listed in the column on the left. We apply a multiple, as we so often do. We're really conservative using the historic mean for the company, if that's in line with the industry mean. In this case, it is, and so we're happy to use that. That gives us our implied prices on the right. We take an average, an equally weighted average, and we get a target price for the end of 2022. So next year, we're looking at $47.26 as an expected target price. So difference between aggregate and annualized here, that would represent a 1.2 times on the upside, okay, or 20% return on the upside. It works out to be roughly 22% as a annualized return or internal rate of return. Okay, so if we were to say, you know, a 5x over 10 years, it's not the same thing necessarily as a 30% IRR. So you want to work out, if you've got a really great return, but it's going to take you forever and a day to achieve that, you need to discount that time value of money. And that's where you use your IRR or your net present values to work out what that means on an annualized basis. And should you go for this big aggregate return, or is the risk not discounted into the expected return? And that's the way that I look at things. That'll become clear in a moment. When we look at this section, normally I give a verdict, to buy, a hold, a sell, or what do we do? So even though I expect the price target to be $47 into the end of next year, we sold our position at $37.48. So why would I do that? Well, if you look at the profits made, I've made 24% as a return over a 2-week period. Okay, so if you annualize that, that's an insanely large return. And so what I've done is taken some profits off the table and said, we'll keep an eye on this company. We've got we think, a good estimate for its intrinsic value. We think that it's run so quickly, sometimes you just got to take the profits off the table, because if you're keeping that annualized return in your mind, that's what's going to make the difference for you as an investor. So if we go all the way back to the first video I ever did explaining the fund and what we're looking to do and how the portfolio is going to be constructed, in essence, the portfolio is meant to be a machine that I have designed and just maintain to give us that annualized rate of return of 20% year on year. It doesn't mean you get 20% every year. It means over a long period of time, 1 decade, 2 decades, on an annualized basis, you're compounding your wealth at 20% year on year as an IRR. And that's where you've got to keep these things in mind. So maybe we could let this run all the way out into next year and sell the shares at $47. But remember, that would only be a 22% IRR. We've got our 24% IRR already in 2 weeks. And that's not an IRR, sorry, that's only 24% in 2 weeks. So if you annualize that, you'll see, what would that be? So half a month, if it was per month, you times it by 12, so you times that by 24% times 24 roughly as an annualized return. So you can see that's insane. Every now and then it does make sense to sell, and although I'm not a short-term trader, and generally speaking we're not looking to buy or sell in 2-week periods unless something new comes to mind, then we've just got to keep this in mind in terms of being able to rotate that capital where it's best kept in terms of opportunity. Same thing with Vale. If you watch the video on Vale, you'll know a similar event occurred. So I had to sell. I've got another opportunity that I can put those funds into to continue that compounding factor. Thanks for watching, and if you haven't liked and subscribed, please do so. It helps me out ever so much. If you haven't checked out the portfolio, then what are you doing? Click on the link in the description and you'll see the portfolio. You'll be able to see those trades. It's got a full ledger of all the history of buys and sells and so on and so forth. So that's the great thing about eToro. It's fully transparent. You can add us to a watch list to see how the portfolio is tracking, or if you've got funds that you need to invest, then just hit the copy button with whatever amount that you so desire, and you'll be starting to mimic the portfolio with me doing the hard work, and you experience hopefully the good gains that we've had. Disclaimer, I'm not a financial advisor and I don't know your circumstances, so you need to be smart and intelligent about the decisions that you make and the advice upon which you act. Please make sure you act responsibly and don't do anything silly. Don't just take for granted something you might hear on the internet from me or from anyone else. None of this is advice. This is just me putting my thoughts forward and showing you what I'm doing with the portfolio that I manage. The rest is up to you, and you need to be responsible for your decisions. Having said that, wish you all the best, and throw in any comments in the comments section if you'd like me to touch on a topic that you are interested in. Thanks for watching, and I'll see you in another video. Thanks guys, take care.